India's economy is growing at nearly 7% a year. Its population has passed 1.4 billion, with a median age of just 28. And right now, one of the cleanest ways to access that entire growth story is sitting 16% below its recent high. NDIA.L is an ETF listed on the London Stock Exchange, run by BlackRock's iShares, tracking the MSCI India Index. When you buy one share, you're buying a basket of around 150 of India's largest companies. It trades at $8.83. The question is this drawdown a buying opportunity or a valuation trap? Let's break down the probabilities. Before we get bullish, let's be honest about the risks. This ETF is down 16% from its 52-week high of 1048. Indian markets have corrected after a strong run in 2023 and 2024, and the Nifty 50 still trades at roughly 21 times forward earnings, expensive by emerging market standards. The rupee remains under structural pressure against the dollar, which directly eats into your returns. And there's a cost drag. The expense ratio of 0.65% compounds against you every year. That's over 3% of your returns eaten by fees over 5 years. Valuations are cheaper than the peak, but they are not cheap. I'm Alex, and this is Probable Alpha, where we use probability-weighted models to cut through the noise and find asymmetric opportunities. Let's look at the mechanics. NDIA.L holds around 148 stocks across the Indian market. The fund has $5 billion in assets under management, meaning tight spreads and strong liquidity. It's UCITS compliant and accumulating. Dividends are reinvested automatically, which is tax efficient for European and UK investors. The expense ratio is 0.65%. That's not cheap, and compare it to 0.09% for SPY, but for single-country emerging market access, it's within the normal range. The US-listed equivalent is INDA, with a slightly lower expense ratio at 0.61% and around $7 billion in assets. The top 10 holdings make up about 34% of the fund. HDFC Bank leads at 6.4%, then Reliance Industries at 6.1%, ICICI Bank at 5%, followed by Bharti Airtel, Infosys, Axis Bank, Mahindra, and Larsen & Toubro. The sector story is critical. Financials dominate at 28%, nearly a third of the fund. Consumer cyclical is 12%, industrials 11%, energy 9%, and tech only 8%. This is not a tech play. This is a financials and domestic consumption play. If Indian banks thrive, this ETF thrives. If they don't, it doesn't. Let's address valuation. India trades at around 22 times trailing earnings. The S&P 500 is at 27 times. Broad emerging markets through EEEM are at 17. Brazil is at 11. China sits at just 9. India is the most expensive major emerging market, but India is also growing GDP at 6 to 7%, double China's rate, triple Brazil's. Its demographics are the best of any major economy. And unlike China, India doesn't carry the same geopolitical or regulatory risk for Western investors. The premium exists because the growth runway is genuinely longer. Whether it fully justifies a 2 times multiple over China is the debate, but it's at least partially earned. Why India specifically? 4 structural drivers. First, demographics. A median age of 28 means decades of workforce growth and rising consumption ahead. Compare that to China at 38 or Japan at 49. Second, the China plus one effect. Global supply chains are actively diversifying away from China, and India is the primary beneficiary. Manufacturing is accelerating under government incentives through the PLI scheme. Third, digital transformation. India's UPI processed over 12 billion transactions last month. The Aadhaar digital identity system covers 1 billion people. This digital infrastructure is enabling financial inclusion at unprecedented scale. And fourth, reform momentum. GST, infrastructure spending, and manufacturing incentives have created the most business-friendly environment India has ever had. Now let's put this through our probability-weighted model. We run 5 scenarios over a 5-year horizon from the current price of $8.83. But here's what makes our approach different. We first lay out what happens in each scenario and what return it produces. Then, separately, We assign probabilities using a mosaic of independent signals, not gut feel. Let me walk you through each scenario. The bull case. India sustains 7% plus GDP growth. Manufacturing exports accelerate under China plus one, and the rupee stabilizes as foreign direct investment flows increase. Corporate earnings growth runs at 15 to 18% annually, and India's weight in global indices rises, pulling in passive flows. In this scenario, NDIA.L reaches $19.60, 122% total return, or 17.3% annualized over 5 years. The optimistic base case. India grows at 6 to 6.5%, reforms continue, but face some bureaucratic friction, and valuations gradually re-rate as earnings catch up to multiples. This gets you to $16.10, 82% total return, 12.6% annualized. The standard base case. Growth moderates to 5 to 5.5%. The rupee weakens modestly, and high starting valuations limit multiple expansion. You reach $12.10, 37% total, 6.5% annualized. The bear case. A global recession hits emerging markets. The rupee depreciates significantly, or stress emerges in India's banking sector. Remember, 28% of this fund is financials. Target, $8.40, roughly flat, negative 1% annualized. The tail risk. A systemic banking crisis, major geopolitical escalation with China or Pakistan, or a sharp reversal of reform policies. Target, $5.65, a 36% drawdown, negative 8.8% annualized. Now let's assign probabilities. Rather than picking numbers from thin air, we build a mosaic from independent signals, each pointing toward or away from specific scenarios. Starting with macro indicators. India's GDP is running at 6.8%. The IMF projects sustained growth above 6% through 2030. And the manufacturing PMI has been above 50 for over 3 years. These signals tilt strongly toward the bull and optimistic base cases. Company fundamentals, or in this case, the underlying index. Nifty 50 earnings grew 14% last year, and consensus expects 12 to 15% forward growth. The banking sector, HDFC, ICICI, Axis, is in the strongest credit quality cycle in a decade. Non-performing asset ratios are at multi-year lows. This supports the upper scenarios. Competitive dynamics. India is winning manufacturing mandates from Apple, Samsung, and automotive OEMs. FDI inflows hit a record in 2025. The China plus one shift is structural, not cyclical. This is a sustained tailwind. Geopolitical and regulatory risk. India-China border tensions remain a background risk, but have de-escalated since 2020. Domestic policy risk is low with continuity in government. No major regulatory shocks on the horizon. Currency signals. The rupee has depreciated about 3% annually against the dollar over the past decade. RBI reserves are strong at over $600 billion, providing a floor. Gradual depreciation is priced into our base cases, but a sharp move would require a genuine crisis. Putting it together. The weight of evidence tilts toward the upper scenarios. We assign bull 20%, optimistic base 30%, standard base 25%, bear 20%, tail 5%. The weighted expected CAGR comes out to 11.1% annualized. Now here's where it gets interesting. Our personalized hurdle for NDIA isn't just the risk-free rate of 4.5%. We add an equity risk premium scaled to this ETF's outcome dispersion, plus a 1.8% country risk premium for India, plus a 0.75% size premium for ETF-level diversification. That gives us a personalized hurdle of 9.3%. NDIA clears it with a spread of plus 1.8%. Not a wide margin, but it clears. Why you might wait. First, valuations. 21 times forward earnings is not cheap, and that premium could compress. Second, the expense ratio. 0.65% annually compounds against you. Over 5 years, that's over 3% in fees. Third, concentration. 28% in financials means you're heavily exposed to Indian banking. Fourth, currency. The rupee's long-term depreciation trend against the dollar can significantly erode returns, even when Indian equities rise in local terms. And fifth, better entry points may come. Indian markets have historically corrected 20 to 30% during global risk-off events. Waiting for $8 or $7.50 would improve your risk-adjusted return. Key risks to monitor. A global recession that triggers emerging market capital flight. A rupee crisis driven by oil price spikes. India imports over 80% of its crude. Regulatory reversal if political dynamics shift. Banking sector stress from rapid credit growth. And the ever-present risk that high valuations simply mean revert without earnings catching up. But here's the case for acting. The 16% drawdown from the peak provides a margin of safety. You're not buying at the top. This ETF offers genuine portfolio diversification. If you're heavy U.S. tech, India is one of the most uncorrelated exposures you can add. The structural story, demographics, digitalization, manufacturing, is measured in decades. The probability model confirms the math works even from today's price. And critically, the expected return of 11.1% clears a demanding, personalized hurdle rate that accounts for India's specific risks. This isn't clearing a low bar, it's clearing a high one. The weighted verdict, at $8.83, NDIA.L is a BI. The expected return of 11.1% clears our 9.3% personalized hurdle by 1.8%. It clears, but the margin is thin. So this isn't a strong buy at today's price. If it pulls back to $8, about 24% off the 52-week high, that upgrades to a strong buy. And at $7.50 near the 52-week low, that's high-conviction buy territory. The numbers to watch: GDP growth staying above 5%, the rupee versus the dollar, the Nifty 50 forward PE. If that breaks above 28 times, valuations are stretched and it's time to reassess. And monitor the banking sector's non-performing asset ratios. That 28% financials concentration is the single biggest risk factor in this ETF. As always, this is analysis, not a financial recommendation. Do your own thorough due diligence before deploying any capital. All investments carry risk, including the potential loss of your entire principal. If you found this analysis useful, hit subscribe and like for more probability-weighted investment breakdowns. See you in the next one.